Today, guys, is all about getting to know you. As Michael said, this is oftentimes the least talked about topic. I know we have some residents and fellows on the line, but in our opinion, it's probably one of the most biggest impact on the rest of our lives, financially speaking. So setting ourselves up for success today will be really helpful as we become into the attending world. And as Michael said, we don't focus enough time on it, and we understand that. So one of the big goals today is just to educate you folks. Some stuff will sound familiar from last year if you were with us, but also some new stuff. I encourage everybody to unmute yourselves, raise your hand. I think we have somebody maybe monitoring the chat box as well, but I'll be monitoring it on the side. If you guys have any questions, like I said, the more you guys ask, the more I can get back. Am I able to share my screen?
You should be able to.
Yes, should be. Yeah.
Perfect. Awesome. Thank you, guys. A little bit about us, for those of you that don't know us, weren't here last year, came into the program. My partner, Jeff, and I, we're financial planners with Northwestern Mutual. A lot of times clients will say, Sean, what does that mean? This is one slide that kind of sums up a little bit about what we do, but we help our clients manage their overall financial, personal wealth goals, come back with a comprehensive financial plan, and all the while in between, educating them along the way. So we'll talk about things like basic risk management, financial planning, investing, college debt reduction or debt reduction in general, budgeting, disability and life insurance and why that may be a conversation, during residency and fellowship, talking about the Roth and taxes and how that will play a role into your plan. Before I hop in that today, does anybody have any questions right off the bat that they want to make sure we address or wondering if we're covering today?
So you sell products as well?
So great question. So we can operate in a couple different facets. So my team and I, we're completely, I am a fiduciary. So, some things we may do may be coming down to selling life insurance or disability. Our goal today is just to educate around planning for physicians like yourselves. Sometimes that comes along with selling on the risk management, but there's also a fiduciary component, as we manage assets. And we could talk about.
You also
And
may
just-
be interested to know we aren't all physicians.
Yes, I was just going to say that we have nurse practitioner students with us as well.
Okay.
Yeah.
Fair enough. Okay, Michael, thank you.
Yeah.
So we could operate on the broker-dealer side, where we're selling a product, or we can operate on the fiduciary side. And surely that would really be dependent upon, what you have in place, what you're looking to accomplish. Was that helpful?
Yeah.
Awesome. So some of this then, Michael, I was not aware that we had some, maybe some students and individuals who are not physicians. This will be a little bit more geared for physicians, but I believe it's critically important that all of us on the line, the numbers may be a little bit different, but ask questions along the way. The philosophy and training should still be the same. So unique needs, right? And this goes for everyone, not just necessarily physicians, but on average, we have higher than student loan average, right? We have higher than the average American does in debt. Our earning years, they're starting later, right? We're naturally going to school for longer than the average. And we have limited time to devote to our overall personal finances. Emergency fund. Everybody asks, Sean, I'm saving into cash, but how much do I need to save? How much should I save? Where do I begin? For us, we believe starting at 1 month of cash on hand and slowly, gradually working our way up until 6 months of cash on hand. We don't like to see our clients have more than 6 months of cash on hand, simply because we're losing about 3% a year for every dollar we have in the bank. What that means is inflation is is rising on the average about 3%. So if we don't have purpose for cash that we have in the bank, we do encourage our clients to get it invested. Whether it's aggressively invested, conservatively invested, we don't care. But just getting it into the market, getting it to have some kind of rate of return that's keeping up with inflation is important. That's always the first goal. It's always our first stop with our clients. Oh, I believe we may have a question. Give me a second. Oh, Jeff, are you on the line?
I am on the line, Sean, but I'm having a problem with technology. So I'm a little bit, the screen is a little small. I'm not sure if anyone can hear me or not.
Yes, I think you're okay and you're unmuted.
Okay. But once again, I'm having a problem with my large screen. So only my camera's working. So Sean, you may have to continue here, but I am here.
Okay, fair enough. So moving on. So when we come to retirement planning and investing, now this is based on physicians, but I would say this holds true with our other clients as well. But 40% tend to feel they're behind for saving for retirement, with only 11% feeling ahead. Well, why is that? And what do we have to do today to change that? So the goal number when we work with our clients is to have them save between 15 and 20% of their income, sometimes less, sometimes more, really depending on, again, how much have we saved, when do we begin saving, and when do we want to retire? I think, looking 30 years ago, most of us were working to 65, 70 years old. Today, a lot of our clients that Jeff and I work with, they want to retire at 50, 55, 60. With that comes, well, there's no more pension. Social Security's, failing us. Ultimately, it comes down to us to make sure that we can save for our own retirement. So we're going to talk about things like utilizing pre and post-tax contributions today, talking about the maximum contribution. So some of you on the line today may have a 403B or a 401k. Both we can put away $19,500 per year. Taxability on accounts. So by far, one of the biggest and most advantageous education we can receive around investing is what is the tax implication of various buckets of money? Well, the left-hand side of the world, right, in this green bucket, that is our short-term savings bucket. This is the pile of money that we're saving that's earmarked for emergency fund. This is our checking, our savings account. Maybe we have a little bit of cash somewhere else under the mattress. Again, we ideally want to see between 3 and 6 months of cash on hand. Maybe a little bit more if we're going to buy a property, right? Or if we're having a child, if we're getting ready for retirement. It really depends on everyone's goals. Column 2 or bucket 2 here, right, is our short-term savings. A lot of us will have this type of an account. This is the brokerage. This is your investment accounts. These are your E-Trade accounts, your Fidelity accounts. Maybe you have some stocks along the way. These are buckets of money that are not the most efficient tax-wise to invest in. However, they tend to be the most liquid. All the way to the right, this is the account most of us are familiar with. These are our retirement dollars, like 401k, your traditional IRAs, your Roth IRAs, your annuities. These are buckets of money that either may be taxable or tax-free, depending upon if you have a Roth or if it's traditional. But these are buckets of money that we can't touch until we're 59 and a half. Jeff, if you want to unmute yourself, if there's a question, go ahead.
Yeah, I'm not sure if this was addressed earlier, but Brandon De Silva has a question. When it comes down to putting away for retirement, 403B, 401k, but also having substantial student loan debt, is it better to pay off loans first?
Great question. It's going to depend, and that's going to be the theme of today. Hopefully it's not. But we want to have a balanced approach to saving for an emergency fund, capitalizing on what we're going to talk about, which is compound interest, meaning getting invested into the market, aka a 401k or 403b or an IRA. And we also want to talk about paying down the debt. The big conversation becomes how much debt do we have? Are we on income-based repayment plan? And do we have a plan around our income and what's left over at the end of the month? Because when it comes to a strategy, it really comes down to how much do we have free cash flow at the end of the month? Well, if we have an excess cash flow, or do we have an emergency fund taken care of? Are we saving into the Roth IRA early on in our career, or where are we tax-wise? And then furthermore, going into the conversation of paying down debt at a rapid pace. I hope that was helpful. And Jeff, do you have anything to add?
Nope, I think that was it, Sean.
Great question. Was there another question?
Don't think so.
And then our fourth bucket, right? So a lot of our clients will have this long-term bucket of money. These are things that we are deferring paying taxes on, like real estate, permanent life insurance. Some of us may have annuities. Why are we talking about the taxability of accounts? And we're gonna get there in a second into the marginal tax brackets. But this may help answer the question. A lot of our clients will say, Sean, what's the difference between traditional versus Roth options? So some of you may be familiar or may not be familiar. It's essentially the traditional, whether it's the traditional IRA, 401k, 403b, 457 plan. We're simply putting in for tax, delay in tax until we're post 59 and a half or all the way up until 72. We're not paying taxes on that money. On the Roth option, we're simply paying tax today, letting our assets grow tax deferred. And as we take out in retirement or after 59 and a half, all that money comes in tax free. Now, there's contribution limits for different accounts. Some of you may be familiar. IRA, anyone that, whether you have a traditional IRA or a Roth IRA, it's $6,000 per year, an extra $1,000 per year if you're age 50 or older. 401k, 403b, 457. As of 2020, those are $19,500. Again, an extra additional $6,000 if you're age 50 or older. And that works for both the traditional and the Roth options. Effective tax rate versus marginal tax rate. A lot of times we have clients that come to us and say, Sean, Jeff, I'm paying an average 32% on taxes. Well, that may be your highest marginal tax bracket, but that's not your overall average tax that you pay on every dollar you make. So here's an example. Marginal tax bracket. Marginal tax bracket is simply this marginal bracket here. So I'm going to pick on somebody that's married, right? If you're making between $0 and $19,750, you're paying 10% tax on every dollar from $0 to the $19,750. There's a little bit of error in here. This should say $19,750. You're paying 12% on the next $19,751 to $80,250, and so on and so forth. When you add up every dollar you pay in tax, that's your effective tax rate. So I'm going to stop myself here. How did I do explaining that? And any questions versus your marginal tax rate versus your effective tax rate? A little bit more on taxes. And again, why is this important? I know we have some folks that are young, right? Probably in their late 20s on the line, and some of us that are maybe in our 50s or 60s. This is the overall last 100 years, give or take, on taxes. Well, overall, where have taxes been? Well, we look back in the 60s, and if you were in the highest marginal tax bracket, you are paying 91% in taxes. Today, our highest marginal tax bracket is in 37%. Well, why is this important? Well, we don't know when taxes are going to go up, but Jeff and I and our team were firm believers that taxes are going to increase. Why? Well, if we look at the trend, we're in a 30-year relatively low tax environment. Social Security, for those that are going to receive it, if we do or if we don't, we don't have a crystal ball, but they're due to run out of money in the year 2035. Now, we do believe that they're going to do something about it. However, we're also trillions of dollars in debt and growing each and every day. There's an argument for those of us that are younger to maybe pay our taxes today in those Roth vehicles versus delaying our tax and using the strategy that was implemented, 20, 30 years ago. Everybody's different on the line today. I can't sit here and say, should we pay in taxes today or not? Everybody is different, but there is a strong argument for paying taxes today versus delaying taxes. I'm going to stop myself there. Jeff, anything to add or any questions?
No, I think you hit the nail on the head, Sean. It's definitely situational. Those of us who are in our 50s and 60s, deferring the taxes and arriving in retirement and paying potentially a lower tax bracket today would be ideal. For those of us who are in upward trend for income and also in our 30s or 20s, it might make a bit of sense to pay the tax today and not have to worry about a potential higher tax bracket in the future.
Agreed. The power of compound interest, and for those of you, again, that this is very basic, we apologize. We don't ever know who is attending, what their level of expertise is. But Jeff and I find the power of compounding interest very important. We actually call it the eighth wonder of the world. For those of you who aren't familiar with what compound interest, it's very simple. It's interest earning interest. And here's a quick snapshot of wanting to accumulate $1 million by age 65, and how much do we have to invest at a respective age? Well, you can see at age 25, it's $381. We arrive at age 35, well, now we have to save $820 a month. We arrive at age 45, we now have to save $1,920 a month. The moral of the story is the only way to capitalize on compound interest is being invested into the market. And we don't care if it's starting at $50 a month or if you're saving $10,000 a month, it doesn't matter. We like to get our clients investing into the market in order for them to earn compound interest. The only way to receive it is simply to be invested. We do find, again, early on in our career, our basic goal with our clients is getting them invested at what's appropriate for their budget. Some of our clients, it's $50 a month. Others are $10,000 a month. Knowing where feels comfortable to you is important, but nevertheless, getting invested sooner rather than later.
Question for that. With this chart, is this kind of like managed funds? Is this people investing by themselves? Is this 401ks? What is kind of like where is this getting the data
is coming from? Great question. So it's based on a 7% rate of return on a portfolio managed, on just a basic portfolio. I can jump into the actual report. Jeff, do you know if it's managed versus non-managed? I know it's a overall portfolio, but do we know if it's managed or non-managed?
I do not have the answer. This is a net 7% rate of return on money.
Correct.
Run managed.
You're welcome. Of any other questions before we move on from compounding interest? Evaluating your risk tolerance. So oftentimes clients come to us, they'll say, Sean, Jeff, what is my overall risk tolerance? Should I be aggressive? Should I be conservative? I heard the younger you are, the riskier you should be. It all comes down to the emotional roller coaster we go through together as we're invested into the market. Some of our clients have a bigger appetite for risk. Others of our clients have a more conservative approach to what they want to feel in the market. So understanding your risk appetite is the number one step for our clients to go through before making investment decisions. Ultimately, we want to take as much risk as you're susceptible to and match the overall rate of return. So for our clients, if we need to get them a 5% rate of return, we don't want to take the risk of going to 10%. Somebody like myself, young, I'm relatively aggressive. Doesn't mean we have to be. I'm going to pick on Jeff for a minute. Somebody like Jeff, he has seen the ups and downs and has been in the market longer than I have. He tends to be more conservative in nature. So overall, making sure as you work with a financial advisor, as you're picking your overall investments and how you want them to grow, are you looking to touch the money soon? Is it long-term investing? And overall, what's my risk tolerance? Jeff, anything to add there?
Yeah, the one thing I'll add is whatever your risk tolerance is, I think the more specific thing should always be how much am I saving and how much of a return do I have to receive so that when I begin to distribute money, it equals what I need net after tax per month. That's always a very key ingredient towards investing and saving.
A little bit more in depth around, our clients will come to us, say, Sean, Jeff, we're looking for an overall savings philosophy. This is not the end all be all, but we find the 20-60-20 spending approach very helpful for clients. And what is that? Well, we earn a paycheck. Paycheck comes in day one. Of the paycheck, the first 20% earmarking and putting towards saving and investing, the first 20%. Now, if we started saving for retirement later, maybe we have to save a little bit more than 20%. If we're young and we've been saving along the way, maybe it's a little less than 20%. But on average, the first 20% going to saving and investing. The next 60% going towards discretionary spending. Things like housing, food, transportation, right? Any debt that we have. And whatever's left over, so if we're spending a little bit more on discretionary, maybe it's a little less than 20%, but the leftover 20% going towards entertainment, dining out, having a drink after work, right? Having a drink after studying, going out to eat, spending for holidays and birthdays. But we find our clients who track their spending and tend to be around the 20-60-20 approach have a stronger potential to being financially independent. I'm going to stop myself there. I believe there was a question in the chat. Does anyone have any questions on the 20-60-20 spending approach? Camilo asks, can we get this PowerPoint? Michael, can we send the PowerPoint somewhere and you can distribute to them? Can we distribute? What would be the best way?
Yeah, I'm happy to share as long as that's okay for you.
Yeah, absolutely. Would be more than grateful to pass this along.
Thank you so much. It's very kind of you.
How many of us on the line, and I know we probably, go ahead.
I'm looking at the 20-60-20 approach. The reality is living in New York City, housing alone absorbs a significant fraction of your income. So that 60% might be closer to 80%. So how do you modify this? Is there a
great question? Yes, great question. So again, every client will be different. However, right, what we would want to look at, let's say, do we have a budget, right? And if it is indeed actually 80%, well, we know we're spending way too much in discretionary spending. What can we eliminate or reduce, right? So that's something where we would go in with a client, start to take a look at their budget and where we can trim off some of the fat, so to speak. So not every single client is going to operate in the 60% discretionary. I know living in New York, Jeff and I are only 50 miles north of New York. It's not as expensive, but relatively compared to the country, New York is expensive. So if we're operating in the 80%, we're finding it hard to spend, finding it hard to save, well, then we have 20% left over, right? That 20% then we put to savings and we have to trim off having fun. Well, that's probably not realistic. So we would dive into the 80% and find out where is the excess fat. Living in New York, we know it's a little bit more expensive, but maybe we, dine out a little bit less. Nevertheless, we want our clients to be actively thinking about saving, maybe day one, they're not 20% saving, but if they're 0% today, maybe we get them to 5%, right? And next year, 6 and 7. I hope that was helpful in addressing your question. And Jeff, if you have anything to add.
No, I think that was the gist of it. You know, it could be difficult. You know, that's 60% of core expenses. Basically, it's saying, hey, taking money in, and it has to go to those core expenses. But I think Sean hit the nail on the head. The biggest thing is understanding your budget. The minute we can understand your budget and knowing how much surplus cash flow we're working with, then we can work from there.
Great question.
Yep.
Any other questions on the 20-60-20 spending approach?
I just want to advocate, as somebody that cares about all the trainees on this call, the importance of this as you enter into your income earning years, and not to be over exuberant in the idea of getting your first paycheck. You know, maybe enjoy that first month, but you should get down to business of taking care of yourself and your family once you've settled in. And I wish that I had gotten this advice that first year. I didn't, or I wasn't listening. Maybe, I don't know. But, yeah.
And Michael, we would definitely third and fourth, your opinion there. This applies to somebody making $30,000 a year or somebody making $30 million a year, right? So when Jeff and I apply this philosophy, it's not if you make X amount of dollars, you apply this, and if you don't use it. It's percentages. So we encourage, even if you're struggling today in residency or fellowship or wherever we are in the field, are we close to 20-60-20? And if not, what can we trim off to make sure we're closer, right? So even again, if we're making 30,000 or next year we're going to be making 300,000, it's the same ratios. It still applies. I would agree, Michael. I don't know how applicable this is for folks on the line. Jeff, I know you're a little bit more adverse in this area here, but how many of us have student loans, or how big of a conversation is student loans?
I think it's a
Anybody?
huge conversation.
What's that?
Pretty big conversation for most of us.
Awesome. Jeff, are you able to see the slides, or should I continue?
I am, and just Sean, I don't have the best view with what I'm looking at right now. So, so basically I have a gist of what's happening here. So basically, when it comes to student loan debt, there is two types of student loan debt. There's standard repayment, traditional repayment, and income-driven repayment. I'm going to go out on a limb here and assume that mostly everyone on the line today is an income-driven repayment. Is that correct?
Yeah.
I thought so. Okay. So we'll focus more on that side of the table versus traditional income repayment. So Sean, if you want to go to the next slide, I'm good. So income-driven repayment. Long story short here, most people in their training years, in the beginning years, as they're beginning their career, the conversation becomes, which program do I go back with? Now, currently, due to COVID, they're obviously deferring the interest. So that's a good thing currently. But then the conversation comes down to, do I pay now or do I defer as we go forward? We feel that making the payments along the way, especially if you're working for a qualifying 501c3, is ideal, being that we're making payments and hopefully can qualify for a PSLF for those who are actually going to apply to the PSLF. The four basic programs here is income-based repayment, the IBR option, very common. Once again, that tends to be the more favored choice of the four. Secondary is the repay option. That'll be on the next slide as we get there. But that also is very, very common amongst the four. The other two options is in the pay-as-you-earn option or the ICR option. They all have their pros and cons, but we have yet to find or have found that many of our clients are going with either IBR, income-based repayment, or repay option, tend to be the most popular amongst the four, those two specifically. Why? Well, A, you don't have to prove hardship or discretionary income. hardship on that, excuse me. You pay those payments as you go forward. And if you look at the specifics, and once again, Sean, I can't see super well because of my screen size. But on the pay-as-you-earn option, cannot have received the federal student loan prior to 2007, must have received distribution after 2011, and must prove financial hardship. So that makes it a bit more of a challenge. If we go to the next slide here, then on the repay option, always pay 10% of the discretionary income, get a government interest subsidy, and fewer requirements in the first two plans. So that makes it a bit more popular. The ICR option is either 20% of discretionary income or payments that are based on a 12-year adjusted amortization schedule. So Sean and I have a bunch of clients that are in the income and general repayment plans. And once again, the most popular of the two is repay and IBR going forward. Traditional repayment. So it's a standard repayment schedule. Typically, we tend to find that people are picking this option once they're in the field of working, not during the training years. Once they're actually working, then as time goes on, they say, hey, should I refinance? Or should I go with a 15-year schedule, a 10-year schedule, a 20-year schedule, a graduated schedule, an extended schedule? So a lot of our clientele are going income-driven repayment as we begin, but end up maybe leveling in the future for having a standardized payment plan. We tend to find that a lot of people, once they get into the working years, they're either refinancing their option to go traditional or refinancing the option to go into a private carrier versus going with the federal government. A lot of our clients are making this decision their first and second years of being on the job, quote unquote. PSLF, Public Service Loan Forgiveness Program. So for those of us who are going for the PSLF, it's a little bit of a challenge, obviously. The approval rating has only been a 4% approval rating so far. And some of that being said is because of applications, not payments not being processed, income not being certified. That sort of situations happen so far. Now, mind you, the program has started back in 2007. So we've had our first decade or so of qualifying payments. So it's like 3 years since that's been completed. So it's a 4% approval rating so far, but a lot of that hasn't been an issue with paperwork. A lot of that has been an issue with just certifying incomes and actually going through and making the on-time timeframe payments. So it's 120 qualifying payments with the PSLF. Income needs to be certified if you're going forward. And once again, you have to be working for a qualified 501c3, non-for-profit organization. Refinancing options I just touched on. So pros and cons, if we refinance with the private lender, you might get a better interest rate and be able to shake off some of the payment years on that refinancing option. Cons, you lose some of the flexibility. Flexibility is the ability to defer payments. Flexibility meaning, hey, in between jobs, I can't pay for this moment in time. Flexibility, if there's a national or global pandemic happening, there could be some benefits there. So there are cons with going and refinancing to a private lender, but for most of our clients, they are refinancing at some point in time.
And Jeff, just as a reminder, when would you say the best time to refinance, consolidate for both physicians and non-physicians? Is it dollar amount? Is it time in their career?
It's definitely time of the career. Once again, it's either first or second year of the position that they're in or going to be in going forward. So it's definitely, hey, don't forget, if your income general repayment, they go off of last year's income. So you have a following year to be in your new position, and then the year after that's when income is looked at. So I would say first/second year of your career to looking at the refinancing options. Questions on any of this so far? Sean, I'll turn the floor back over to you.
Perfect. That was it on the offensive side of the world. I'm going to take a pause here. I'm monitoring the chat. Does anyone have any questions around financing, investing, retirement planning, the tax conversation? I know we went through a lot in a short amount of time, but were there any questions or anything we didn't address on that side of the world that somebody has a question on that would like us to address?
Yes, in regards to capital gains taxes, I was reading that I think it's the capital gains tax. If you make a profit off of capital gains below $40,000, it's a 0% tax rate. Then goes up to 15% to 25% based on income from selling assets. Could you talk a little bit more about that? About like the time frame on selling assets, like for instance with stocks, if you need to hold stocks for greater than a year in order to avoid capital gains, if you make below 40 grand. Could you talk a little bit more about that? Because I know it's going to be different compared to say a 401k or an IRA where you hold it for a long period of time. So I was just wondering.
Jeff, I'm going to defer this one to you. I know we were just talking about this the other day. I think we just did some research that may be helpful.
Sure. So it's single versus married filing jointly. So if it's under 80,000, married filing jointly, single is the 40,000 number. The capital gains tax has to be held or longer than 13 months to avoid the capital gains. Also, part of that is also what's called combined income. Combined income being any earned income, capital gains as they be paid out, any pension programs coming to you, and if Social Security becomes partially taxable income equals your combined income. So monitoring your combined income in total will dictate how much you pay in capital gains tax, and also has to be held longer than 13 months to avoid that. Does that answer your question?
Yes. So for instance, if you buy a stock, you have to hold that stock for 13 months. You can't just sell it and keep it in, like, for instance, your like TD Ameritrade account, and then you don't pay the capital gains, or do you have to hold that stock?
So there's short-term and long-term capital gains tax. Short-term capital gains tax is a higher percentage, long-term is a lower percentage. So depending upon when you buy, when you sell, will dictate whether you're short-term or long-term on the tax world.
Okay, great. Thank you.
You're welcome.
Any other questions on the offensive side? Again, investing, risk tolerance, student loans. Any questions before we switch gears a little bit? Awesome. So as equally important as we talk about investing for the future and how attractive investing for the future is, something oftentimes not looked at or overlooked or not thought about is protecting what's most important to you, which is your ability to go to work each and every day, whether we have families, and protecting those types of assets. So we're always in favor early on in our career, right? Having the conversation around disability. It's not one that we relatively enjoy having with our clients, but we know it's essential to their plan. So 76% believe disability insurance is essential. However, only 11% feel prepared enough in the event of a disability. Well, why is that the case? And how does group disability, we always have that conversation, Sean, I'm all taken care of. I have group disability at work. Some questions that come to mind, and I'm going to skip ahead for a second, that come to mind with disability is, how do we protect ourselves or our income outside of disability, right? So Jeff and I are big believers. There's really 3 ways, right?
I'm sorry for cutting you off, but just so that we don't miss this point, what do we mean by that phrase, 11% feel prepared in the event of a disability? What do you mean by that? What are we getting at here?
Yep, great question. So 11% feel prepared, meaning they have enough in disability insurance or enough in some type of asset that's going to replicate income. Okay. So essentially 11% are feeling that they're on the mark, they're on track. Was that helpful?
So the disability benefit, should an event happen, the disability benefit will be able to account for their present income?
Correct. So I was going to hop into that in a second. Yes, but disability income, right, or disability insurance, right, there's both short-term and long-term disability insurance. But long-term disability insurance, right, when we talk about long-term disability insurance, that's the income that's going to replace our paycheck. God forbid we get hurt, sick, or injured. Typically speaking, right, and every employer is going to differ, right? So if we're getting new contracts or moving or just entering, residency or fellowship or wherever we are, we're going to have typically between 60 and 67% long-term disability given to us, right? So what we're talking about is if that's not given to us, well, that's one question we're going to have, right? Or one conversation we're going to have. But second, is that 60 or 67% enough, right? So what I'm saying is only 11% feel that they have enough in protection, God forbid, that their income was taken away from them tomorrow,
Period.
whether it was sickness, health, or injury.
Thank you.
Was no problem. And this may further allude to why that may be. Now, this is painting the strokes for those folks on the line that are going to become attending. Even if you're receiving 60% from your employer, it starts to become an issue when we make above $250,000 a year. That goes from anyone that's making above $250,000 a year. Those that are falling below $250,000 a year can be affected too. Not only is there a percentage limit on group long-term disability, oftentimes there's a threshold, right? A cap. The average between 10 and 15,000 bucks per month. So you can see on a net take-home pay of 250,000 bucks, it's about $16,000, right? After 60%, well, if we have a cap of 10,000 bucks per month, our net take-home pay from that 60% benefit is only 48%, right? As we make more, that decreases. So questions to consider when we talk about disability income is A, if I don't have it, how am I protecting my future $1 million career, right? Or multi-million-dollar career, depending where you're at in your career. So questions we have our clients ask themselves. If they have group, great. Still ask the questions. If they don't, and you're shopping the market for supplemental benefits, still ask the same questions. When do the benefits start, right? How long will the benefits be paid? Are they going to be paid for 1 year, 5 years, until age of retirement or age 67? Are there cost of living adjustments, right? Is it 1%, 2%, 3%? What definition of disability is being offered, right? What's the whole premise behind the contract? You know, if I get hurt, sick, or injured, can I go work somewhere else and still receive a new income and receive my benefit? Is essentially what we'd be asking. The second important topic is as we shop the market, again, whether it's Northwestern Mutual, Mass Mutual, Guardian, it doesn't matter. Understanding the financial strength behind the company that you're looking into disability insurance with. Because just like anything else, God forbid something were to happen to you, the point of having disability is so that that insurance company is behind the contract, right? So reading up on the insurance company, doing your homework, finding out, do they have enough in assets to pay for disability for you, right? Do they have enough in their general account portfolio? Start looking at the overall construction of the financials behind the company. Before I move on, I don't want to spend too much time, why disability is important, but here's a few things to highlight. Any questions around disability income, how it plays a role into the overall, comprehensive plan?
Yeah, this is, excuse me, this is Shirley calling. I have been advised not to get disability insurance.
Okay. And my question to you, Shirley, if you don't mind, what was the details behind not recommending disability for you?
Having being older and having no dependents.
So Shirley, maybe disability at this point in time may or may not be a conversation. There's typically 3 ways to talk about a disability, right? A, we simply do nothing and we risk our career. So Shirley, it really depends. If you're going to retire next year, you probably have enough in assets where you don't need disability insurance. But if you're going to work another 10 years, right, and let's just say over that 10 years, you're going to bring in $1 million or whatever the number is, then maybe disability is a conversation. So having no dependents is one thing, but don't forget, Shirley, if you became disabled, do you have enough in assets to support your lifestyle? And when those assets run out, who's then going to take care of you? Right.
Well,
so if you have that all figured out, then disability probably.
I'm old. That contributes to the equation.
You're not old.
Well, I get a pension. I get a pension and I get Social Security. So
So most likely, Shirley, for somebody like yourself, long-term disability isn't a conversation. Again, everybody's unique. Typically, folks that are early on or mid of their career, it's disability. When we're towards the tail end of our career, it's something that comes off or, off our balance sheet, or maybe we don't have at all. Really, you would have to take a look at the numbers. Surely, I wouldn't want to give you a blanket recommendation.
No. And part of the reason I raised that issue is because I was thinking about how, as we come in contact with older adults who ask questions, another common one is about whether or not to get long-term care insurance. And so, and not that I would ever advise people about what was in their financial best interest, but I think to make sure that when we're dealing with our older adult clients, that we at least raise some of the issues that they need to talk about when they go to somebody.
Absolutely. So that's one conversation we have with our clients, right? Is the conversation around Medicaid, Medicare, right? Long-term care, do we put our assets in trust? So, again, long-term care insurance has a stigma, just like life insurance and disability insurance, but does it fit into your overall plan, right? Some clients need long-term care insurance, right? Or should have it at least. Others don't have enough in assets where maybe they become a ward of the state. So again, looking at the plan and why Jeff and I come in here with unbiased recommendations, right? And just as a conversation to educate you folks is because we can't give blanket recommendations, right? Sometimes long-term care or disability could be great for some clients and not good for the other clients. So to answer your question, Shirley, there's pros and cons of long-term care insurance and disability, right? And I think being educated on those pros and cons are where we come in and help our clients. And as a consumer, asking these questions, hopefully, Shirley, are helpful. Awesome. Any other questions on the disability side of the world? Life insurance, most of us on the line here are familiar with life insurance. There's a few different types, but the two basic types of life insurance, term and permanent. Term life insurance, let's start there. I think it's our most often known about. It's insurance that's simply in place that, God forbid, you prematurely leave the earth. A beneficiary or multiple will receive a lump sum tax-free cash, right, to their saving or to their checking, whatever they choose. But they're receiving a lump sum of cash tax-free. You pass away within a certain term. Well, we can get a lot of coverage for cheap amounts, but at some point in time, right, as it's known as it's a term, it's going to expire. Well, as we get older, right, and as we get into our 40s and our 50s and our 60s and 70s, the clients that Jeff and I work with, their mindset starts to shift, whether it be I want to leave money behind for my grandchildren, or I want to leave money behind for my children, or I want to have, coverage until I'm, 90 years old. Whatever becomes important to you, permanent life insurance may be another conversation. The key difference there is, yes, it's a little bit more expensive, but you're no longer renting your insurance. It's on the books forever. And there's also a cash value component. Basically a glorified savings account that earns some kind of dividend rate or return. So it's a form of a savings account. And I could talk about that a little bit more. I know we're running close on time here. But why do clients come to us, and why is life insurance a conversation? Well, again, the cover debt, God forbid we're no longer here. If you and your spouse have any debt on the books, maybe it's to wipe off some of the debt. Future childcare costs. Future college costs for children. Maybe we want to just leave our spouse in a good spot. But more importantly, don't forget, if one of us were to leave, where does that leave our family, right? How much income did we lose? Well, if we're in our 30s, we had probably a 30-year working career, right? Do we want to replicate some of our income? So start to understand, A, do I need life insurance? And B, how does it fit into my overall portfolio? Any questions there? Jeff, anything to add?
Nope. Think it down ahead there, Sean.
So what do we advise our clients to do next, right? So for those of us that have loans, figure out, is it time to consolidate? Is it time to refinance? Should I talk with somebody? Begin on debt. Second step is let's start saving for retirement. We don't care if it's as little as 25 bucks a month. We encourage our clients to begin saving. It's the hardest part of it all. And last, and in conjunction, is getting basic risk management in place, whether we have to go do some homework and see what the employer is offering us, or if we have to circle back because we bought a plan, 10 years ago from an insurance agent. Just knowing the details behind it is very important. If all of you on the line today, Jeff and I are going to stay on for a few minutes, answer any questions you have. Feel free to put it into the chat or unmute yourself. But if you don't mind taking a picture or typing this into your URL, it will lead you to a 60-second survey. It's the best way Jeff and I can improve on what we talk about to programs like yours. We can improve for others across the country. And to generally give us feedback on what we can also edit, remove or delete from our slides. We're always looking to improve so we have a better experience with you folks. So if you don't mind, again, just taking a minute, use the camera on your phone or a QR scanner that will take you right to the survey. It'd be much appreciated.